Good morning. Hello, everyone, from a snowy New York. My name is Eric Lund, and I'm a senior economist here at the Conference Board. And welcome to our monthly Economics Watch webcast. I have the great pleasure of hosting and moderating today with some colleagues. And we're going to be discussing the U.S. economy in some detail over the next hour. Some of the key questions that we're hoping to answer and explore with you are how has the U.S. economy performed in 2019, and how have the growth drivers evolved over the last year? Where does the U.S. economy presently stand? And peering around the corner into 2020, what are our expectations for growth and what will be driving growth? Finally, we're going to be exploring some of the risks to our forecast, both on the upside and on the downside. So as always, you can participate in the discussion, and we'd really like for you to do so. Please use the chat box on the bottom left of your screen. Type your questions in, and we'll either weave them into our discussion or answer them directly. Feel free to download the presentation as well and share it with your colleagues. You can switch between full screen and video in this webcast by clicking on the 4 arrows at the top right of your screen. There's also a brief evaluation at the end, and we always look for your input on how to improve future webcasts. This webcast is also being recorded, and you'll be able to come back to it later on or share it with your colleagues later today. Finally, we're also offering CPE credits. If you're eligible, please type in your full name and email into the space provided. You'll need to click on the OK pop-up 3 times over the course of the webcast, and you'll need to stay online for the entire webcast. And the credit is only available if you are joining us live. So to dive into this subject, I'm being joined today by 2 of my colleagues. Frank Stiemers is the associate economist here at the Conference Board. Thanks very much for coming, Frank.
Thanks, Eric.
And of course, our favorite, Gad Levanon, our chief economist for North America. Gad, thanks very much for joining us.
My pleasure, thanks.
Sure. So I think we're going to dive straight in and open up the conversation with an audience poll. If you can bring that poll up, please. So we're looking to get some input from you as we launch into this topic. Looking back on 2019, did the U.S. economy come in where you expected it to a year ago? So in December of 2018, 1 year ago from today, what were you thinking about the U.S. economy? And have we sort of moved in that direction? Did we fall short of those expectations? Did you meet the expectations? Or indeed, did the U.S. economy exceed your expectations for this last year? Why don't you take a few seconds to think about that, and then we'll close the poll and discuss the results.
I'm already looking at some of the responses, and
it looks like it's pretty much done. Let's go ahead and close that poll. So let's see here, 44% of you said that it met your expectations. 41% said that it exceeded your expectations, so even stronger growth than you had expected. And only about 15% of you said that it fell short of your expectations. So it seems, for the most part, maybe upside surprise for the most part. Frank, do you have any comments?
I think that there were, of course, some recession fears, at least the media cycle. And you read a lot about it. We had an inverted yield curve, which was scaring a lot of people. So I think that many people were maybe expecting, okay, economic growth is going to really plummet this year, and that is actually not what we have seen. We will talk later about what we had forecasted, and that is more, it met our expectations.
Sure.
But so this is not a surprise to me.
No, it's not. It's not too much of a surprise, I suppose. Gad?
Yeah, well, exactly a year ago in December 2018, it was a terrible month. It's exactly when there was an escalation in the trade conflict. It was a stock prices collapsed, interest rate collapsed, but perhaps more than anything, what was scary then is that consumer spending also stopped growing. So given that weakness that we had in December, that actually continued in January and February to some degree, I think we ended up in a pretty good place.
Yeah, no, it's agreed on that. You know, I don't think it's really fair to ask the audience to reflect back on where they were a year ago without doing it ourselves. And so I put together a special slide for us to sort of bare our soul to you in terms of where we were in December of 2018 versus where things actually wound up. The dark line that you see here is what actual growth has been for the 3 quarters for which we have data for this year. And the red dashed line was our forecast a year ago. So I feel like we did a fairly good job. We were right about the general trend. There was an uptick in the first quarter and then a gradual slowdown throughout the remainder of the year. So I'll pat us on the back a little bit. Of course, the actual numbers were a little more volatile than we had predicted. So for 2019 or for 2020, our expectations are the dashed yellow line that you see. We'll talk about this in great detail over the next hour or so. But we're expecting sort of stable to slightly weaker growth in the coming year. We may indeed see a bit of volatility. It's hard to read the tea leaves on a quarterly basis, but our expectations are for weaker growth for this coming year. Okay. It appears that we're having a slight technical issue, so we're going to reset some of our equipment. If you'd please stand by, we'll be back with you momentarily. Hi everyone. Sorry about that. We had a brief technical glitch that we've since ironed out. So we'll continue on with the discussion. We just finished conducting an audience poll in which most of you answered that U.S. GDP growth in 2019 came in about where you had expected it, if not a little bit higher. And we shared our expectations with you as well. So what we're going to do now is we're going to look a little bit backward on the last year and just sort of give some broad strokes on some of the things that we saw that influenced the economy over the last 11 months at this point, not quite 12. So as I mentioned, a year ago, the Conference Board expected U.S. GDP growth to moderate over 2019, and it has. Consumer confidence and consumer spending have held up relatively well over the last year. Buoyed by a really strong performance in the U.S. labor market, which we'll talk about shortly. Business confidence, on the other hand, has not done nearly as well as consumer confidence has. Indeed, the CEO Confidence Index that we produce here at the Conference Board has really plummeted over the last several quarters. And that's really been reflected in some of the poor capital spending that we've seen, which of course has been a drag on U.S. growth. In addition to private consumption, government spending this year has helped offset weakness in other parts of the economy. And financial markets have remained strong, and the Fed policy has come in, I think, a lot more dovish than we had expected this time last year. So we've had several cuts in rates, and I don't really think that most economists had expected to see that level of dovishness. Finally, despite efforts to address the trade imbalance, 2019 has seen the largest deficit on record, as income growth and consumer demand also mean U.S. imports is importing more from the rest of the world. Are there any other points that either one of you think are important for 2019 that we should reflect on a bit?
I think maybe when we think about business confidence and spending in different sectors, we have really seen a divergence between manufacturing and the non-manufacturing sector. Mm-hmm. So the manufacturing sector has been especially weak, and we're going to talk about that in more detail. We have actually many slides where we're going to show why the manufacturing sector is not doing as well as the rest of the economy, mm-hmm. the rest of the U.S. economy. In addition, housing, we haven't mentioned that yet, was pretty weak in 2017-18, start of 2019, but there we actually now see a good recovery. Mm-hmm. So that is providing some boost to gross domestic product.
Absolutely. Gad, anything that you're burning to say about 2019?
Between the two of you, you covered everything, I think.
Yeah, all right. Well, let's move on then a little bit and just sort of give our broad stroke overview of what we expect for 2020. So as mentioned a few seconds ago, U.S. GDP growth should remain moderate as the economy sort of converges on its 2% long-term growth trend. So again, that's somewhat slower than we saw in 2019. We'll be kind of moving down to about 2%, but it's certainly not any sort of deterioration in growth or plummeting. And at this point, we don't expect to see any sort of a recession over the coming year. As employment slows, consumer confidence and consumer spending could moderate a little bit next year. So the kind of tailwind that the consumer provided in 2019 probably is not going to be quite as robust as we've seen this year, that we'll see next year. At the same time, however, we're expecting business confidence to pick up a little bit, which could improve real capital spending. Government spending, it's difficult to know, but possibly flat to maybe a little bit down for 2020. And then on the Fed, the kind of dovishness that we've seen in 2019, at this point, we don't necessarily expect to see this sort of mid-cycle correction, which is what they've been calling it, to continue into next year. Of course, there are a number of factors that will possibly change that over the coming 12 months. But from where we sit now, we're not expecting any major changes in Fed policy. Finally, on trade, we're probably likely to see the deficit rise even higher into 2020. As weak global demand, we're actually expecting the global economy in some markets to slow down a bit. That could damage U.S. exports. The U.S. economy, on the other hand, I think is still going to be in a relatively strong position relative to its peers, and so import growth shouldn't really not be affected in the same way that exports are. Again, either one of you have anything to add on 2020?
Well, I would just say that the combination of moderate revenue growth and a tightening labor market, which will, the combination of those two will hurt the bottom line. And I think probably one of the biggest risks for the economy in 2020 is how will companies react to a squeeze in corporate profits? Are they going to cut spending more? So far, it hasn't been, certainly not on the employment side, hasn't been a big factor, maybe more on capital spending, but hopefully it will not spread more than that in 2020. It probably will not.
Good points. So now that we've sort of shared our thoughts on next year with you, we want to get your input. So we actually have another audience poll. If we could pull that up, please. Okay. So looking forward into 2020, how do you expect U.S. economic growth to perform? Strongly accelerate, moderately accelerate, remain relatively stable, moderately decelerate, strongly decelerate, and of course the big scary question, are we on the cusp of a recession? So let's give you just 1 or 2 more seconds here to weigh in. And let's go ahead and close the poll. So, well, it looks like we have a consensus with our view. It looks like a moderate deceleration took first place, with about almost half of the audience voting on that option. The second highest one is stability. So really, I think the Conference Board really lies right in there between those two options. We have about 17% that are expecting actually a modest acceleration in growth, and only 2 people voted for a recession. So that's makes me feel a little bit more confident in our own expectations. Gad, do you have any thoughts on what the audience thinks about next year?
Well, you know, the country is evenly divided, and also our audience is almost exactly 50-50 between those who think it will decelerate and those who think that it will be stable or accelerate. Maybe I would have expected a little more positive, but not really surprising. Yeah.
Okay, all right. That having been said, I think we should maybe move on, and our next topic is kind of a glimpse at our leading economic index. Gad, would you mind talking about this a little bit?
Sure. So we are seeing the chart shows that in the last 6 months, our leading economic index was flat, which is pretty unusual, but not that unusual. You can see that it happened several times in this expansion, usually during periods of a slowdown. But you see that it's very far from the behavior of the leading index in times of a recession. Also, I think some of the weakness in the leading index was a result of the weakness or even recession in manufacturing, which our index is heavily concentrating on. And so we know that the rest of the economy is doing better than manufacturing. So I think it's, we certainly should monitor it. I would be more concerned if we see a few more declines in the leading index, but at this point, it's far from a recession signal. Yeah,
no, agreed. Speaking of which, we wanted to maybe break down some of the components of growth for next year that we forecasted, and Frank's going to walk us through some of these components, some of the primary ones. There's a lot, of course, and give you some guidance on really how the growth drivers are expected to shift over the next 12 months.
Right, so let me take you through the chart, Eric, and our audience. So what we're looking at are like the main components that go into GDP. So we have in the red line non-residential investment, we have in the green line consumption, we have in the blue line government spending. So what we have seen, I want to start with 2019 and then talk more about what we expect to see in 2020, and Eric has already introduced some of the concepts here. So we saw that especially non-residential investment was especially weak in 2019, at negative growth actually. But on the other end, we had consumption and also government spending that was actually very strong, especially government spending picked up. Of course, that was also related to the bipartisan budget deal, so there was more money to spend. Now going forward, if you think about 2020, we expect that investment will start to recover. Also related to that, we expect that the weakness in the manufacturing sector has maybe now reached its bottom and will start to improve. So this means when non-residential investment will be somewhat stronger, we expect that consumption growth will still be solid in 2020, but somewhat softer, and the same goes for government spending.
Just real quick, audience question here. What is PCE exactly? Would you explain that real quick?
PCE, yeah, I use the abbreviation here. So that's personal consumption expenditures.
That's basically consumer spending,
Yeah.
is what we're talking about there. Okay. And then I think at this point we're going to talk a little bit about labor market expectations, both where we've been over the last 12 months and what we expect over the next 12 months. And Frank, I think you and Gad are going to split this topic. So why don't you guys go ahead and spend a few minutes going over these slides and laying out sort of your views.
Yes, sure. So I can start with the main introduction on the US labor market on a national level. Gad and I, of course, work in our Labor Market Institute, besides doing work on the US economy. So we have had the pleasure to do a lot of work on labor markets. So we're happy to share some of these results here. But just to start with the main indicator, I think, in the labor market, which is employment growth. So what we're looking at here is the 6-month annualized growth rates in employment for the blue line, that is the total non-farm employment, the red line, the manufacturing industry. So first, let me start with the blue line. So what we saw was actually in 2018, so I go 1 year further back, when employment actually accelerated, which was pretty remarkable, but also aligned with very strong economic growth in that year. We had expected 2019 to be somewhat soft in terms of employment growth, and that is also what happened. Interestingly, though, in the second half, so over the last 2-3 months, we have seen employment growth pick up actually in the total economy. Thinking about 2020, also when we look at our employment trends index, so that's one of our leading indicators for employment, this also signals that employment in 2020 will likely be somewhat softer, but still relatively solid. Of course, when we now look at manufacturing, so the red line here, you see how different the picture looks for the manufacturing sector. At some point, it was actually growing negatively. Maybe now in the last month, we got, of course, also this was related to the strike at GM. So some more workers returned to manufacturing jobs. But even besides that, there was a positive momentum. So maybe there, going into 2020, we will see some recovery into manufacturing employment.
And again, a part of our forecast for 2020 is not just in the U.S., but in a variety of countries around the world, is to see a bit of an improvement in industrial output. So I think that's consistent with not just our U.S. view, but with our global view as well.
Yep.
Right, so to continue with the labor market on a national level, let me go to the next slide, where I'd like to talk a little bit about labor market tightness and about wage growth. So first, let me tell you what we're looking at. Here in this chart, we have the dark gray line, that is the unemployment rate. What we see, it came in November at 3.5%. It is now as low as it was in the late 60s, also showing how tight the labor market now is. I think also if we look at other indicators of labor market tightness, broader measures of unemployment, like if you look at those working part-time for economic reasons, this is much lower now. If we look at voluntary quits rates, a lot of this much more labor turnover. If we look at for example, company surveys, we see that a lot of companies are having hiring difficulties. So that in terms of labor market tightness and going into 2020, we expect that this will just continue. Employment growth is still solid. We know that from the supply side, we have labor force participation rates that are picking up, but not that fast to offset this trend. So the supply side is not growing as fast, and also the working age population, which would mean if that is growing very fast, we get a lot of extra people on the supply side, but also there we see that the working age population is barely growing. So we expect that 2020, this will just continue towards a tighter labor market. What we have seen, to turn to wages, we do see some acceleration, and this is also what you would expect in a tighter labor market. There may be some reasons why wage growth is maybe still a little bit lower than it was in 2007, maybe a little bit lower than the 1990s. I think important to think about here with wage growth is, and Gert is going to talk about that in more detail, is that we do actually see strong wage growth, but not per se on a national level, but if we look at specific occupations. So for example, in blue collar jobs, we see much stronger wage growth compared to, for example, the highly educated management and professionals. And also when we look at wages of new hires versus existing workers.
Yeah, and I think, as you mentioned, this is something that never happened before. Well, maybe never is a strong word, but we actually looked back through the 70s, and what we see here, we've never seen in that period. So we broke down the wage growth into two groups of occupations. So first, in the red line, we're looking at management professional and related. So those are the highly educated white collar, almost 40% of employment. And because almost all of the high earners are in that group, way more than 50% of total labor cost. And in their case, wage growth accelerated moderately. It's still well below pre-recession rates. But if you look at all other occupations, they are already above pre-recession rates. And that kind of consistent gap in favor of the blue line is something that we haven't seen since the 1970s. And
I'm going to interrupt you for a second. We have a quick question from the audience. How much do you think increase in the federal minimum wage plays into some of these numbers?
No, that is part of it, especially in the occupations that pay really at the bottom of the wage distribution, like food services and cleaning and those types of jobs. But the other reason why that's happening is that we are seeing, we have a lot of evidence that labor markets are simply tighter for those jobs. We have several reports that talk just about that, so I wouldn't be able to do it justice. But the bottom line is that there aren't enough people who are willing to work in blue collar and manual services jobs, and the demand for those jobs keeps on increasing. So the combination of not enough supply and to fill the demand is creating a historically tight labor market in those jobs.
And how much do you expect this to change over the next year? I mean, is this a trend that we're going to see slacken a bit or continue strong, or what are your thoughts on what's ahead?
Well, I think from a demographic perspective, it's only going to get worse because we have projections of working age population by education, and for those without a BA, we are seeing an accelerating decline. Whereas for people with a BA, we are seeing a steady, solid growth. So from a demographic perspective, this trend is likely to get worse. Now, the big question is, are companies going to be able to automate many of those jobs? And we haven't seen strong productivity growth in the last decade. Hopefully the next decade will be better in that regard.
So I think we're going to talk a little bit about...
there is a question exactly about the automation. How impact total employment in low-skilled or unskilled occupation as minimum wage is raised in your forecast? So that's exactly the big unknown. We are seeing, if you squint really hard, you are able to see some green shoots in labor productivity growth, but it is too early to celebrate, I would say.
Yeah, especially, the impact in one calendar year is probably going to be limited. That's more of a long-term story than than something that's going to manifest itself in just 2020. But certainly, it certainly has the potential to modify our longer-term forecast of not just the U.S. economy, but a lot of economies around the world.
Yeah.
Did you want to touch on the wage gap for a second?
Sure. Well, one of the interesting things also that we found in our research is that new hires, especially those entering the labor force for the first time, are seeing strong wage growth, but existing workers, people who rely on for wage growth on their annual raises, are seeing a much more modest increase for various reasons, low inflation being one of them. Companies are not raising or giving as rapid or as strong annual raises as they did before the recession. Now it's more around 3%, where it was 4% before the recession. So despite a very tight labor market and 10 plus years of expansion, companies are not really accelerating that yet. So as a result, we are seeing, and this chart shows it well, we're looking here at the ratio between the wages of workers 20 to 24 and workers 25 to 34. So it's always less than 100%, of course, because the older workers are making more money, but we see the gap between them is now the smallest that it's been since the 80s at least. And that reflects the fact that wage growth for those entering the labor market is growing very rapidly.
Well, I think we've done a pretty good job at sort of giving our impressions on the labor market. So maybe we can pivot a little bit.
Yeah, just can I add one more, because please. I see there was one question that asked about the demand for different occupations. So maybe, Kat, you can say something about that. That we see, of course, these supply trends for, especially in strong wage growth for blue collar occupations, less so in white collar occupations. But what about the demand?
Well, so typically, I think there was expectation that the demand for blue collar and manual services jobs will be very modest, especially after the Great Recession. But we are seeing in recent years actually pretty solid growth. So for one thing, in the last in this expansion, manufacturing growth, employment growth rate has been the strongest since the 70s. A lot of the automation and offshoring that took place earlier is not happening, or happening much less now. Also, the spread of e-commerce is significantly increasing the demand for drivers and warehouse workers. The aging of the baby boomers increasing the demand for health support workers and personal care workers. So there's still a lot of demand for people without a BA in this country.
Sure. Thank you. So yeah, as I mentioned earlier, we're gonna pivot just a little bit and talk about the consumer in 2019 and what we expect for 2020. And Frank is going to lead us through that conversation.
Right. So let's start to talk about our own consumer confidence index. So what we're looking at is the consumer index, and there's basically two components: what people expect of the present situation and their expectations in the future. I think what doesn't show on this chart, but if you compare these numbers to historical averages, currently consumer confidence is very high. And this is, of course, also related to what we were just talking about in labor markets. The labor market is very healthy. More and more people have a job. We see strong growth in disposable incomes, strong wage growth. So that also means that when you especially think about the consumer, they have more money to spend, so they are more confident about the economy. Just about the two differences between present situation and the expectations, I think also always expectations are more influenced by the news cycle. And the news cycle is, of course, always a little bit geared towards not the best news. So then you always see that is relatively lower, sometimes some more volatile, but overall I would say the main takeaway here is that consumer confidence was strong in 2019 as it was in 2018.
But I mean, even though we have this strong confidence levels, we still have expectations that next year we're actually going to see consumption actually start to decelerate a little bit.
Right. So in this chart, what we are looking at is the 3-month percentage changes, really to see like the the momentum of consumption growth. So we have seen that actually in the second half of 2019, it was really the consumer that was driving economic growth. It was somewhat slower now in the last quarter, in the last months. We expect that consumer spending will continue to be strong in 2020, but likely not as strong as we have seen in this.
Yeah, and that's of course related to labor market evolutions and developments.
Right,
as well.
If employment growth slows down,
Yeah.
also less people will find a job. So then directly it also means that consumption will grow a little slower.
Yeah.
But still solid.
Yes.
Yeah.
Yeah. So that's sort of our brief take on the American consumer. We want to pivot once again and talk a little bit about business in America. We just went over how basically well the consumer confidence index has been performing. This is a little bit more of a long-term chart as well. So Frank just showed you really the last 2 to 3 years. This goes back to basically the financial crisis in 2008. And you can really see how well consumer confidence has been sort of growing. On the other hand, the Conference Board also gauges how CEOs and C-suite executives are feeling around the country as well. And really starting in 2018 or so, even though the consumers were feeling great, business leaders actually began to feel a lot less optimistic. There's a lot of reasons for this. One of the things that is often cited by executives is the uncertainties that surround things like the U.S.-China trade war. But really, this pessimism and lack of confidence has manifested itself in a number of ways. You can see, for instance, by looking at the Purchasing Managers Index, the PMIs within the manufacturing sector and the services sector, both have been trending down throughout the year. Manufacturing PMIs are actually below 50, which is in contractionary territory. So I think especially within that sector of the economy, businesses in manufacturing and heavier industries and things like that are really taking it on the nose right now. Services have also slowed, but they're still in positive territory on the above 50 in the PMI. So manufacturing and goods producers have been suffering a little bit more than services have. Looking into the future, we expect that some of the volatilities that have been grating on businesses like the U.S.-China trade dispute to moderate in 2020. And as a function of this, it's likely that we'll start to see a little bit more confidence among business leaders. And as we mentioned earlier on, we're also expecting to see industrial production in the manufacturing sector pick up as well. So there should be a bit of a tailwind coming from businesses over the coming year. We're going to stop for a second and talk about corporate profits as well. Gad's going to touch on that a little bit.
Yeah, you know what, and let me go 2 slides back as an introduction to corporate profits, because sure. I think one of the reason of this divergence between the consumer and CEOs, well, there are 2, I think, reasons. One is all of the people surveyed in our consumer confidence live in the U.S., whereas the CEOs, those are CEOs of large, in many cases, multinational companies, so they are impacted a lot by also the demand in other countries. And the U.S. in the last year did better than most parts of the world. So that's one reason. But the second reason is at the same time that there is strong demand and a tight labor market which helps consumption, those things are hurting profits. And that is also something that weighs on or keeps the CEOs at night. So when we see here, this is what we see here is as a share of the gross value added of non-financial corporations. So gross value added is something very close to revenue, so you can think of it as revenues. And we see that in recent years, as the labor market tightened, the share of wages and salaries in revenues increased, meaning that wages and salaries grew faster than revenues. And as a result, the share of profits declined. So we see a significant squeeze on profitability rates, and that partly explains the lack of confidence of CEOs.
Great. And I think we're gonna again tackle a slightly different topic and talk about sort of the financial environment in the U.S. And Gad, I think you're going to also help us with this.
Yeah. So one of the things, I mean, as we summarize 2019, one of the major developments in I think in the U.S. economy and in other parts of the world was that the Federal Reserve switched gears early on in the year. In January 2019, they already said we are not going to raise interest rates anymore. We, if anything, going to lower interest rates, and they did lower interest rates several times during the year. And as a result, throughout 2019, we've seen a dramatic drop in interest rates and mortgage rates as a result,
which is in fact, helping to fuel perhaps some of the resurgence in residential investment, and people are taking out more mortgages and refinancing, doing additions, and that's been showing up in the GDP numbers as well. So this is where the rubber hits the road in at least one respect to this. Looking forward into 2020, the guidance that the Fed has offered up till this point recently, I know that the FOMC is meeting today, is that things are kind of not too hot, not too cold about where they need to be, and that this sort of mid-cycle adjustment that has been going on through 2019 is sort of it's completed. The Fed doesn't see any need to pivot or to raise or lower rates any more than they already have. Moving into 2020, what do we think about this policy? Is it going to last? What do we think about Federal Reserve moves next year?
Well, I think an increase would be very surprising. I mean, I think they would need to see a massive hike in inflation to even consider raising interest rates. So I think that's unlikely. Also, after the strong jobs report last week,
absolutely,
I think the likelihood of further interest rate cuts is also much smaller, at least for the next several months. So I think if our forecast will materialize and we will grow at around 2%, then probably the most likely scenario is no change in Fed's interest rates.
Sure. One of the other interesting developments that happened this year was related, of course, to the yield curve inversion. Why don't you talk about that a little bit, where we are now with respect to yield curves, and if another inversion were to occur in 2020, could that affect Fed policy, perhaps?
It may. I think the yield curve is an important leading indicator, but it is perhaps not the best, and one of many. And in the history, we had periods where there was an inversion, and I think there was even once where inversion happened, and only 6 years later there was a recession. So sure. I think that's why it's an important thing. It certainly gets a lot of media. But if we want to kind of judge or gauge the risk of recession, we should look at in combination, other leading indicators, and which we aggregate in the leading index that we showed earlier. And I think that is telling us that we should be a little cautious, but not an imminent recession.
Yeah, I mean, one of the things people say is that yield curve inversions have predicted 5 of the last 3 recessions.
Yeah.
And I think it's also important to note that since this historically long U.S. Economic expansion, we've had a number of yield curve inversions over the last 5 to 6, 7 years or so that didn't result necessarily in a recession occurring. So it is important to watch. It typically is a necessary condition for a recession to occur, but not a sufficient one. So we'll continue to monitor this. But where we're trending currently, things look relatively positive. I want to briefly touch on equity markets. This isn't really within the core wheelhouse of the Conference Board. We don't do stock picking, of course. We don't make recommendations on equity markets generally. But really, I think that the performance of equities this year has been extremely positive. We've seen a pretty substantial gain from January, and there is a lot of concern whether or not this can last. Are we in a bubble? We don't necessarily have an answer for that. But moving into 2020, I think there is reasonable concern about how long can this last for. Again, we don't have necessarily an answer for you, but I think provided that the U.S. economy doesn't really decelerate quickly, or there aren't some shocks to various sectors within the economy, I don't necessarily think that we're on the cusp of any sort of a big correction in equity markets. I don't know if either Gad or Frank have any thoughts on this that you'd want to weigh in on.
Yeah, no, I think it is indeed very difficult to forecast. Sometimes it goes down, but we see that they very much have also been reacting to what is happening between the US and China and that trade dispute. Mm-hmm. So probably in 2020, they will continue to react to what is happening there. Mm-hmm. And I think you will talk a little bit more about that later in the next slide.
Well, I think also the positive momentum in stock prices in 2019 was, a lot of it was driven by the historically low interest rates. Mm-hmm. And that's likely to continue. So sure. I think investors will keep searching for a yield, and they won't get it in bonds or in the bank. So I think still money will flow, whether or not it will be strong enough to offset some of the other impacts. And I think a negative impact will be the declining profitability, which I expect to continue to see in a lot of corporations.
Yeah. Well, Frank brought up an interesting point, which was the question that dominates Bloomberg News and Yahoo Finance and all these other networks almost every day, which is the U.S.-China trade dispute. But before we kind of dive into that single narrative, I think maybe it would be helpful to just have a look at how export and import growth have been trending in the U.S. Both have on an annual basis, year-over-year growth. We have seen a little bit of a weakness in these numbers recently, but on the whole for the year, even though the trade deficit is ebbing down just a touch on a monthly basis, if you look at it in annual terms, again for 2019, the U.S. is going to be reporting another record trade deficit. We don't necessarily expect this to change in 2020. The U.S.-China trade dispute is ongoing, and there are attempts to basically hash out what's called a mini deal, or a stage 1 deal is what the administration's been calling it, in which some adjustments are made to Chinese purchase of agricultural goods and things like that, which should theoretically reduce the trade imbalance between the U.S.-China a bit. But overall, I mean, the aggregate imbalance between the countries is so large that I don't think next year, even if we do have some sort of a deal, that we're going to see much of an impact on the trade deficit. It still will be very large. Maybe it won't be quite as big as the 2019 deficit, but I wouldn't be hopeful that we're going to have any sort of real change in that number for next year. Simultaneously, for import growth for next year, I think we're expecting imports to perform fairly reasonably. considering that the U.S. economy is moderating growth-wise, while a lot of the outside world is slowing down. Those same set of scenarios are going to create an environment maybe where the export environment overseas for U.S. goods and services isn't quite as strong either.
So can I ask you one question on the U.S.-China trade dispute? So up to now, I know you have done some research on who has been more, sorry about that, who has been more impacted. So just on the numbers, the U.S. or China?
So the Conference Board has done some really interesting work in this space where we've essentially looked at something called value-added trade. And certainly China's economy is a lot more dependent on trade broadly, about 19% of GDP, and the U.S. specifically, about 3.1% of China's GDP. If you revert that, the U.S. economy, about 9% or so of U.S. Economic output is consumed overseas, and only about 0.7% of that output is consumed in China. So we're talking about an asymmetry of about 3.1% dependence from the Chinese side versus about 0.7 on the U.S. side, which is a 5x sort of asymmetry, if you will, between the two. That having been said, China's economy is a lot less dependent on trade than it once was. It's working to get away from that export-led growth model, the infrastructure-led growth model as well. So, the short answer to your big question is yes, it has an impact, but some of the elements that are driving the slowdown in China are internal elements as opposed to the trade war itself. From the U.S. side of things, I don't think we've really felt it too much here. I think American businesses that source from China have felt the effect of the tariffs because the tariffs have primarily been focused on those kinds of goods, but consumers haven't really felt the brunt of it yet as a function of the administration really trying to avoid consumer goods. That could change if the current negotiations fall apart. Tariffs could be implemented on those goods, and U.S. consumers could start to feel that heat a little bit more. But we're getting close to the top of the hour, so I want to go through just a few of these slides quickly. On housing, as Frank mentioned earlier in the webcast, we saw a real improvement in housing residential investment in third quarter GDP growth. Prior to that, it had been basically in contractionary territory for, I think, about 2 years or something like that, quite a while. So that's a tailwind for growth going into next year. And we think it's going to continue because if you look at some of the early sort of indicators that are associated with residential investments, namely housing starts and housing authorizations, so when developers are getting permits to build, we've seen a real strong uptick in the latter half of 2019. And this is indicative that of an environment where we're going to start to see more bricks being piled up on top of one another to build walls, lumber being shipped into neighborhoods for new houses, things like that. So residential investment, from our perspective, moving into 2020, is going to continue to be a positive driver of economic growth. I wanted to also just quickly talk about some of the risks, both upside and downside risks to U.S. economic growth. But before we talk about maybe some of our thoughts on this, I wanted to give you an opportunity to weigh in on yours. So let's open up the poll here quickly if we can. All right. Looking into next year, what do you think the biggest risks are? Again, this is just a list of about 6. And there's certainly a lot more, but these were the 6 that sort of were on the top of our minds. What do you think about this? Trade tensions between the U.S. escalating, consumer growth weakening more than anticipated, inflation picking up, a further deterioration in manufacturing activity. On the upside, an acceleration in productivity gains, and also on the upside, potentially, depending on why it's done, further monetary easing.
Yeah, so in this question, the risk is not just a negative term.
It can be upside risk or downside risk. So both opportunities and challenges for growth. Maybe I should have used those words instead. A little easier to understand. Apologies. So let's go ahead and close that poll. So it looks like about 45% of the audience is focused on the consumer and weakening growth. About a quarter, 25%, escalation in U.S.-China trade dispute. A little bit of concern about inflation picking up, and some people thinking about manufacturing activity as well. So, fellows, any thoughts? What do you think about these votes?
Well, I think in consumption, of course, businesses are all looking what is the consumer going to do. We're very dependent what are our sales going to be. Mm-hmm. So that is an obvious risk, of course, in 2020 that it will be slower. I think for the escalation in U.S.-China trade dispute, that can lead to spillover. So I think that is, of course, also something to watch. And I would have picked these two probably.
Okay. Gad, you're on the same page about?
Yeah, I think those are the two main ones.
Okay. Yeah. All right. So these are some of our perspectives on these risks. Again, we expect the global economy to grow at about 2.5% for next year. If the global economy starts to perform better than that or worse than that, of course, that's going to have either a positive or a negative impact on the U.S. economy. We are in line with you on the trade war. It is a risk that could damage growth. That having been said, as I noted earlier on, we do expect some sort of a partial trade deal over the coming months, and not necessarily an escalation in hostilities. There are certainly elements of the trade war that are not going to be resolved over the next 12 months, but I think the dimensions of the trade war that are really driving the tariffs have a good potential to be addressed. One that I saw earlier on from an audience member is on the U.S. elections. And indeed, the ongoing impeachment inquiry that's going on in the Congress. So we don't forecast election outcomes. We're a nonpartisan group, so we don't have any positions on these issues in terms of how they're going to turn out or whether they're justified or not. That having been said, this not just the election year, but also the current impeachment that's going on in the Congress. They introduce business uncertainty into the equation. And we're expecting businesses to get a little bit more confident moving into 2020. But this, of course, is a downside risk. If things get messy, if policy volatility becomes very high, that could damage confidence among the business community. We also are concerned about U.S. consumers. A loss of faith among consumers, which represents 70% of the U.S. economy, has the potential to hurt overall growth. The stock market, as we said, it looks like things are lining up to, it's difficult to see triggers for a big sell-off for next year, given some of the things that we discussed. But of course, that's a possibility as well. And then productivity gains, increases in U.S. productivity could be on an upside risk in terms of accelerating growth. We were going to talk about productivity a little bit more, but I think we're running out of time. So we're going to wrap up. Here is an overview on a quarterly basis of our outlook for 2020 and a historical reference for 2019. And I want to encourage all of you to come back and join us next month. We're going to be discussing the C-Suite Challenge that the Conference Board conducts. I'll be moderating, and I'll be joined by our economist Ilaria in Brussels, and Chuck Mitchell as well here in New York. So thank you very much for taking the time out of your day to spend some time with us. Hopefully you learned a few things. And we'll look forward to seeing you in a month's time. Thanks so much.